Gold just crossed $5,100 an ounce. Silver shattered every record it ever set. And if you're wondering why half the financial world is panic buying shiny rocks while the other half insists everything is fine, you're asking the right question. It's about what happens when the safety net everyone assumed would always be there starts to look like it's made of tissue paper. Here's what you need to know upfront. This isn't a normal rally. It moves like this when something breaks, or when people think something is about to break. Right now, two massive forces are colliding. The United States government is hours away from a potential shutdown, and new tariff threats are ricocheting through global markets like a bullet in a steel room. Gold hit $5,100. Silver blew past its 1980 record, adjusted for inflation. And here's the part that should make you uncomfortable. This surge isn't being driven by optimism. It's being driven by the absence of alternatives. Gold is called a safe haven asset, but that phrase hides what's really happening. Gold doesn't pay interest, it doesn't grow, it doesn't produce anything. Why? Because gold is the asset you buy when you don't trust anything else. Not your government, not your currency, not the stock market, not bonds, not banks. When confidence cracks, gold becomes the default. It's been that way for 3,000 years, and every attempt to break that pattern has failed. Right now, confidence is cracking. The U.S. government is facing a funding deadline. Parks close, paychecks freeze. The global perception of American stability takes another hit. They raise costs, disrupt supply chains, and invite retaliation. They're fleeing because they're terrified of everything else. Central banks printed money, stocks went up, and bonds paid something. Gold spiked to $2,000, then pulled back when vaccines arrived and life resumed. And that should have killed gold, because higher interest rates make holding a non-yielding rock expensive. Except gold didn't die, it stayed elevated. Then it started climbing again, and geopolitical tension kept escalating. Wars, trade disputes, debt ceilings, shutdowns. Every time the system wobbled, gold ticked higher. It's accelerating. The U.S. national debt is over $36 trillion. The government is fighting over funding again. Tariff threats are back on the table. Gold isn't rallying because the future looks bright. It's rallying because the future looks uncertain. And uncertainty is gold's best friend. Now let's talk about silver, because silver is even weirder. Silver just broke its all-time high, not nominal, actual. Adjusted for inflation, the previous record was set in 1980 during a market corner attempted by the Hunt brothers. It's used in solar panels, electronics, and batteries. It's also hoarded like gold when people panic. That dual nature makes it incredibly volatile. When industry booms, demand rises. When markets panic, speculation explodes. Right now, both are happening. Those industries devour silver. At the same time, retail investors are piling in, convinced silver is undervalued compared to gold. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been collapsing. When it drops below 60, silver is considered expensive relative to gold. We're not there yet, but the move has been violent. And here's the uncomfortable part. A lot of the retail buying is speculative. That's not investing, that's momentum. And momentum works great until it doesn't. A tariff is a tax on imports. When the U.S. imposes tariffs, foreign goods become more expensive. Consumers pay more, and trading partners retaliate. The current threats are aimed at China, Mexico, and Canada, 3 countries that account for nearly half of all U.S. trade. If these tariffs go into effect, prices rise, and inflation ticks up. Gold doesn't care which path the Fed chooses, it wins either way. The market is pricing in both scenarios at once, which is why the move has been so aggressive. But when the U.S. government can't agree on a budget and threatens to shut down, even the dollar starts to look fragile. Gold doesn't have a Congress, it doesn't have a debt ceiling, it doesn't need a spending bill. That's the appeal. A government shutdown doesn't mean the government disappears. Essential services continue, but non-essential functions freeze. National parks close. Federal employees are furloughed. Past shutdowns have cost billions in lost productivity. They also damage confidence. If the richest country on earth can't pass a budget, what does that say about its stability? If confidence erodes, those buyers pull back, yields rise, and the deficit grows. At $5,100 an ounce, the total value of all the gold ever mined is roughly $60 trillion. Central banks hold a massive amount, private investors and jewelry account for the rest. That creates liquidity problems. When everyone wants to buy and no one wants to sell, prices spike. Silver has the same issue, but worse, its market is smaller and thinner. Big moves happen fast, in both directions. Now, layer in leverage. Futures contracts allow traders to control large positions with small amounts of capital. The current rally has been fueled in part by momentum and leverage. That doesn't make it fake, but it does make it fragile. And here's the uncomfortable math. If gold is at 5,000 because of fear, what happens when the fear subsides? History says no. Gold often crashes after fear peaks. Let's separate the signal from the noise. The rally is real, the fear is real, the risks are real. You'll see headlines claiming gold is going to 10,000, that the dollar is collapsing. Sometimes they're right, but most of the time, they're just early. And in markets, being early is the same as being wrong. What is notable is the speed of this rally. 20% in a few weeks is unusual. That kind of velocity suggests dislocation, not steady accumulation. Sometimes higher, sometimes lower. Gold is at $5,100. Silver is at record highs. But fear is also temporary. The question you should be asking isn't whether gold is expensive. It's what you think happens next. If you believe the system is broken and that geopolitical tension will worsen, then gold at 5,000 might look cheap in 6 months. But if you believe the system is resilient and that central banks will stabilize things, then 5,000 might be the top. No one knows, not the analysts, not the traders, not the central bankers. They looked at the world and decided a chunk of inert metal was safer than the promises of governments and the projections of economists. That should tell you something. Whether it tells you to buy or to stay away, that's your call.